Hello, and welcome to Trusts and Estates Weekly. I'm your host, Kevin Bemmel, and we're here every Monday morning at 10 o'clock, Pacific time, I should say, and 1 o'clock on the East Coast. And we talk about all things related to estate planning, managing trusts, settling estates, and dealing with probates, both from the standpoint of your personal finances as well as that of professionals who can help you with all of the various matters associated with preparing for what's going to happen when you're no longer here, and making sure that your wishes are carried out as well as possible. So this morning, I have as my guest David Kottler. David is a lawyer and is best known as the life insurance doctor. And David and I had a conversation about this a few weeks ago. Really a unique individual in the estate planning area, and so I said to David, I have to have you on the show. This is something that people really need to know about. And so without further ado, David, first of all, welcome to Trust and Estates Weekly. Thanks for coming on.
Well, thanks for the invite, Kevin. My pleasure.
So let's start off with just talking a little. Most people think about life insurance as something they get to make sure that if they die prematurely, there will be some money there to help their those surviving them, their family or other people, be able to continue their lives. If you would tell us your perspective, what is the purpose of life insurance? Why should we even deal with it as part of our estate planning? As someone who's been involved in this particular financial instrument for a long time.
Well, that's a short question with probably a lot of answers. I think that as I think back to my days in law school, we actually had a course in insurance law, and the definition of insurance is basically shifting the risk. That's why people buy, property and casualty insurance or all the other types of insurance they have to buy with whatever their careers or something is. Here it's a known risk because everybody's going to die. They say, you can't get out of this world without dying. So, for those that care about their family or care about their community, insurance is an outstanding way to preserve the lifestyle and the needs of their loved ones and their community. And everybody knows, markets go up and down, values go up and down. Life insurance is one of the most safest investments. I'm going to call it an investment in a policy and that's a big if it's handled properly. And the way that I actually got the idea for the life insurance doctor was after having worked several years with a prominent estate planning and tax attorney, legacy planning attorney in the Chicago area, and he saw what I was able to do to help either fix, repair, replace, or sell. One of those or nothing. Not every policy needs work. So 30% of policies that are out there are okay. Probably 65 to 70% of policies need to be reviewed because otherwise there will be some probably unpleasant surprises for the policy owners. And there's a lot of reasons for that. But to go back to the purpose of insurance, the purpose of insurance is to provide liquidity. That liquidity, again, could be used to support a family where the breadwinner, if that's the case, is no longer bringing in any income. Maybe he's not maybe the assets aren't what they were hoped to be. Sort of the fail-safe way to do it is to have a life insurance policy which is funded properly and designed properly that's going to last to maturity, maturity being the death of the insured. And this is where the huge problem comes in because 90% of insurance policies do not last to maturity. And people go, no, that can't be. Yeah, that's the statistics. And I liken it, I sort of made an acronym, DOA, dead on arrival, for what I see as the three biggest factors in not having life insurance policies last to maturity. Call it DOA, D for design flaws. How you design a policy is very, very important, especially for those types of policies, which a whole different area of planning goes into, and that's for retirement income. It's become very popular and for good reason that insurance policies are used to augment retirement income
Mm,
because life insurance has several large tax benefits, which no other investments do. The growth inside an insurance policy is tax-free.
mm,
The ability to distribute dollars out of a properly funded retirement insurance policy are tax-free. The distributions are tax-free.
mm,
There are some provisos, like you cannot let a policy that you have borrowed money from lapse. Lapse means the policy run out of money, the policy terminates, because that would leave you with not only no insurance, but a very unpleasant tax impact because the government will view forgiven debt equates it to ordinary income.
mm, mhm,
So a lot of people are not familiar with that, but that's what happens if somebody borrows so much money out of a policy that the policy cannot sustain itself, or the policy owner is not willing to put as much money in as it would take to sustain it. That leaves a very nasty tax impact, again, ordinary income,
mhm,
for the amount of the debt forgiveness. And the insurance carriers are required to notify the government if such an event has happened where there's been a forgiveness of income.
mhm,
So if we break down the purposes of insurance, and I'd say the simplest way to do it is two categories. One category is going to be for providing estate and tax benefits post-death. That's for in the bequest area. And this is, you know, a very, very large portion of the purchases are for that purpose. The other purpose, though, is again to augment retirement income because there are all kinds of um, people that want to invest, and there's all kinds of people selling these types of policies. We call them IUL, or uh, individual universal life,
mhm,
indexed universal life. And the unique thing about indexed universal life products are that you have the ability to participate in the market without the market risk. That's where a lot of these products have gone recently, which is great for consumers. Again, if it's designed properly, but it's great because how would you like to have the ability to have what we call a floor guarantee? No matter how bad the market is or was in any given year, you're not going to go below zero on the investment component of your insurance policy. So these are indexed universal life. They're indexed to the S&P or to any of the other, ETFs that insurance carriers are using, and they generally have a cap rate, the highest you can earn on it. But the big advantage is that there's probably a 2 to 3% benefit on an overall return in the market if you have a floor guarantee versus no floor guarantee.
mm,
So people find these policies, which again, if people have sufficient income and they want to augment for retirement purposes, a lot of people call it like a Roth on steroids. With Roth, there's all kinds of contribution restrictions, but the Roth does operate in the same way. Once you get the money into the Roth, once you get the money into the policy, you have that dual tax benefit of tax-free growth and tax-free distribution.
Mm-hmm.
So it's a very appealing thing. And then, of course, which always happens in the insurance industry, people will take a good idea and try to leverage it to make it even better. And leverage can make good things good or bad things worse.
Right.
So, if all you have to do is look at the papers today and see a slew of people that have been sold something like we call premium financed life insurance, where we want to leverage that result. So we're not going to use our money. We're going to borrow money from a third party bank and they're going to fund the policy. And the buildup is going to happen inside the policy because we have this dynamic where if you design the policy properly, there's usually an arbitrage, 2 or 3% between the borrowing rates, the interest borrowing rates that you would have versus the crediting rates.
Mm-hmm.
Well, in the last 2 or 3 years, we have been the recipients of some very bad news with interest rate increases,
Mm-hmm.
and that has really thrown a monkey wrench in these types of arrangements. And we've had choppy markets, so you've
Mm-hmm.
had sort of that perfect storm where you have a lot of people that entered into contracts to augment retirement income, or even if they were financing it even just to for purpose of estate planning and the liquidity, you have these policies that are what we call underwater. So, we had a situation recently where there was a very large policy. The client had a $50 million policy that he had premium financed. At the end of 2 years, he was already $2 million, what we call underwater. So in other words, he had borrowed more money for premiums and of course, the cost of interest from the banks, 2 million in the hole on his program. And yeah, he was not very happy. And part of the work I do as the doctor is to analyze these types of situations, and we have a variety of third-party relationships, strategic relationships, and strategies to help people that have problems. So we partner with a private equity firm that is a huge believer in the efficiency of cash value inside a life insurance policy. So
Mm-hmm.
that's what I wanted to try to highlight. It's like the example where a knife could save a life if it's in the operating room, but a knife could kill somebody if it's in the hands of a thief or a robber. So it's
Mm-hmm.
like life insurance can be fantastic, fantastic investment, fantastic property, or it can really hurt you financially. And so my work has been directed, it's just my nature. I like to solve problems for people. And in this regard, for people that if they're listening or they may know somebody that has a situation like this where they've gotten, call it upside down, call it underwater, call it simply, they have much more money borrowed out than what the value is. We have what we call a rescue program for these kind of people, where we
Mm-hmm.
can help them retain a lot of the death benefit they have. They're going to have to pay the bank what they're in the hole. There's no free lunch, but for a relatively small sum of money over and above that, we can help them because that we have this partner who's a funder that strongly believes in the value of properly designed life insurance and what you can do to generate good returns within the policy,
Mm-hmm.
so long as that policy is funded properly. So,
So you mentioned DOA as being an acronym for the three problems with with life insurance. So D is design. What are
design
what are what
flaws.
are O and A? What are O and A problems then?
So O would be the omission to pay the proper amount of premiums.
Hmm. Okay.
Okay. A lot of people, like I even have CPAs that said to me, well, I thought, once we buy a policy, we put it in the drawer and that's it. We just pay the premium every year or we don't have to look at it. Well,
Hmm.
you're talking about a financial instrument that has so many moving pieces that is market interest rate sensitive and market rate sensitive and mortality cost sensitive and insurance carrier profitability sensitive. These are all the factors that go into how a carrier will price their policies and maintain them as they go. And
Hmm.
every carrier is different. You got some that are A plus and they're really very legitimate in the way they do it. Then you got some that'll rob Peter to pay Paul, which leaves the people that are, not getting the benefit of an increase that they should have gotten or a decrease in some regards because they're trying to buy new business. So the A is a lack of a proper review. So we have design flaws, we have the omission to pay the proper premiums, and A is a lack of a proper review. Why do you have to do a review? Because of all these multiple facets to an insurance policy. And an accurate insurance review is not the 3 or 4 sheets of paper they send you at the end of the year, which is a very, very tiny, concise snapshot of a few of the factors that go into how is a policy performing. To put it in the medical analogy, it'd be like if you're ready for your top executive workout and you go to the clinic and the doctor says, just give me a few drops of blood, we'll figure out the rest. Well, if that's how you want. I wouldn't recommend that as a health alternative. So to get the proper analysis, what we do is we require obtaining a number of what we call illustrations, in-force illustration. In-force means the policy's already in force. Now we need to test how it's performing. What
Hmm.
happens if this? What happens if that? Where are we at today? So it takes analysis, um, and it's a B. It's the critical first component toward gauging the health of the policy. An educated consumer is far better off than one that has no idea. And you hear stories just every day. Wow, my premiums just went up 30%, or I'm out of cash in my policy. How did this happen? Or things of this nature. So, as a public service to a degree, we offer a cursory review for policies that are $500,000 or higher,
Hmm.
and we don't charge for that. And we will let clients know what the health of their policy is, at least from a brief review standpoint. Hey, everything's good, or maybe you should do this or add this. Again, sometimes probably at least 35% of the time, there's no major problems with it. It's
Hmm.
the other ones that have other major problems. But we've been able to um, I had some clients from this attorney that I was working with, and they had already put in like close to 200 or $250,000 into a retirement policy, like what we were talking about,
Hmm.
and they were getting ready to drop it because they said it's not performing at all the way it was supposed to perform.
Hmm.
And I said, well, let's get on the phone with the carrier. I see some problems with the way it was designed. I want to see if I can work with them to redesign the product
Hmm.
so that we reduce the amount of death benefit, because you're not buying this for death benefit. The purpose for which you're buying it for is retirement income.
Hmm.
Okay, so if you want to maximize your retirement income, you don't mind reducing your death benefit because what you've done is taken a lot of the costs out of the policy. Your
Hmm.
mortality costs, they go up every year and they can get extremely high. Well, at the end of, like, let's say less than a half hour, we were able to redesign the product to show them where we literally found, I mean, we created $250,000 of retirement income for them projected on a policy they were going to throw in the garbage. They're going to cash it in. They weren't happy, and that was what they were going to do.
Mhm.
So,
So it sounds like the types of policies that you're finding value in. You're talking about things like whole life, universal life, variable policies, those kind of things where there's some kind of value being accumulated in the policy. Um, what about term life where there's just it's really just you pay your premium and your life is insured for the term of the policy, whatever it is, 10, 20 years. um what do you see as the potential problems with a term life policy, which seems like you should just be able, like you were saying, the accountant, you buy it as long as you pay your premiums each year, you just throw it in the drawer.
well, so you bring up a very good point. I got on this topic of retirement planning and whatnot, but there's a whole nother area of work that we do, which are called life settlements.
Mhm.
Life settlement came about 20, 25 years ago. Some very smart people figured out, wow, the consumer is really getting sort of cheated because they had no choice. If they didn't want their policy anymore, the only choice they had to deal with it was turn it back into the carrier that issued the policy.
Mhm.
That'd almost be like, oh, well, I bought this house 30 years ago. Now I want to sell the house. No, you got to sell it back to the guy that built it or sold it to you originally for like a loss. So this whole industry got developed. It's a multi-billion dollar industry today, but probably a tiny percentage of seniors are taking advantage of the opportunity to convert their policies to cash if they're at a certain age. And this could either be term policies or permanent kind of policies.
Mhm.
I'll separate those two issues. It's simple on the term policy side. There's two things that have to be in place for a term policy to have any value. One is that the policy itself is convertible to a permanent policy
Mhm.
because a buyer that's what we're talking about with life settlements. These are third party buyers, Warren Buffett. There's a lot of TV advertising you see for various huge hedge funds buying policies. These are the buyers of the policies. No
Mhm.
one is going to buy a policy that may not last as long as the insured does because then they've wasted all their money. If
Right.
they buy a policy, they know for certain the policy will be there if it's properly funded. When that insured passes away, then it's viable that you could sell it. So first, it's got to be convertible. Secondly, there has to have been a change, usually fairly significant, in the health of the insured. One of the benefits of term insurance for most people that get it is that they buy it with a convertibility feature to it, which every carrier is different. The standard seems to be about age 70. You can convert up to, sometimes it's less. If you bought the policy and you're over 60 or 65 when you purchased it, you may only have 5 years. But in general, 70 or 75 seems to be the Cinderella date where past that you cannot convert it.
Mhm.
So we had a case recently. It was a friend of a friend, and unfortunately, the mother-in-law had gotten brain cancer,
Mhm.
and she had a term policy, a group term policy from Walmart actually. And so she had paid very, very little money into it. It was a term policy. Maybe she had paid $5,000 into it. I think it was a $150,000 term policy that was able to be converted to a permanent policy. Well, once she converted that policy to a permanent policy, we were able to get them like close to $100,000 tax free. So over half the value. She had a 2-year life expectancy. So The buyer, they go by the medical records. Some people live longer despite what the records say, and obviously some people die sooner, but the standard is there's a record taking process, and there's a report that you have to buy called a life expectancy report. But this was, like, very, very helpful to them because she had to go into a much higher care facility, which was $6,000 or $7,000 a month, and they couldn't have her at home. She needed the extra care. She had this policy. It could be converted to cash, no tax on the sale, even though she'd only put in less than $5,000.
Hmm.
They
Wow.
received they received close to $100,000 on that. So that's an example of how we can find money value in a term policy.
Hmm.
Again, if it's convertible, and if there's been a health change. Obviously, she had a big health change.
Hmm.
The other aspect of settlements is where you have a permanent policy. Maybe it's run out of cash. There's a lot of reasons why people want to get rid of their policies. And it's a staggering amount of dollars and policies each year that lapse that are senior owned, where the people don't take advantage of the potential for selling it for money that they could well use. It's a very slow educational process. There are these companies out there that are doing an enormous amount of TV advertising on it, but the seller, it needs to be beware in those situations, because the people that are spending $1 million a week on TV advertising are paying low dollar to the sellers.
Right.
They are not setting up an auction process the way a broker does. An end buyer is buying for his own purpose. So when you buy something for yourself, what do you want? You want it for as little as possible.
Right.
If you're a broker and you're charging a success fee based on success being the amount of cash that you're getting on the policy versus what the return value would be,
Hmm.
then you're interested in getting the highest and the best price. So one is buying for himself, the other is buying for 20 or 30 or 40 other potential buyers.
Right.
And that's where people can get caught up in not being careful about where they go to get rid of their policy if they don't want it anymore.
And
You
if
know,
if someone sells a policy that has um where the money borrowed on the policy basically renders the value of the policy zero, if they're still able to sell that policy, then they're not, is it the case they won't be tagged for debt relief by the IRS?
yes.
Wow.
Yeah. Well, plus we have this private equity partner that will step in and bail people out of loans if the underlying policy is a valuable policy.
Hmm.
So there's you could either get a loan and get out of the problem, or you could sell it and get out of the problem. And
Right. So
yeah,
even if you get zero out of the policy, the tax savings alone could make it worthwhile, it sounds like.
yeah, but generally, generally we'll get them. It won't be just like walk away with nothing. Be
Mhm.
walking away with getting rid of the problem and some money in their pocket.
Wow.
Yeah.
That's a great program.
Well, we're gonna be advertising it more on LinkedIn, and we want people to come. Again, if it's they realize, I've had situations where we'll start spending 1 hour, 2 hours, 10 hours, 20. I said, you got to pay the hourly charge if we're going to get into this extensive analysis and you want all this. But I can give you 80% of where you sit, or 90% of where you sit. It doesn't take me that long. We review hundreds of policies,
Hmm.
and it's on my website, lifeinsurancedr.com. All they need to do is go there. We have book a meeting. We have a calculator that can actually anticipate what the value of a policy, if you're looking to sell it, is. I should make the statement that policies where the insured has a long life expectancy. By long, I generally mean 20 years or longer, could even some companies are more particular, 15 years or longer. It starts losing value to the buyer because if they're paying money up front, they want a return on their money. If they're
Right.
waiting 15 or 20 years to get their money, it depresses the value.
Sure.
So to qualify, like a sort of just a general guideline are men who are 73, just for example, and older, have a policy. Women that are maybe 77, because women, tend to live at least 4 years longer than men,
Right.
and have a policy. They're sort of have a good chance of having some value. Somebody's 50 or 60 that's in good health. No, that's not going to have a settlement value. They may qualify for a loan program. They may qualify for a rescue program, but
Mhm.
that's what we want to be. I want to be a provider of a variety of services to deal with whatever the issues that may exist are.
Great, great. Well, the half hour unfortunately just zoomed by. We're actually over time, so we'll have to have you on again to talk some more about this. There's obviously we've just kind of hit the surface here, but there's much more to this. So David, thanks so much for coming on the show. I appreciate it very much. And you mentioned your website. It's lifeinsurancedr.com.
Yeah, life insurance spelled out, lifeinsurancedr.com.
Okay, and I'll put a link to your website in the show notes. So for those of you who are watching, whether live with us now or you're watching it recorded, if you look down into the show notes, you'll see a link to. I'll put a link both to David's LinkedIn profile, but also to his website where you can go and you can get information about how David can help you with your life insurance policies. So. David, thank you very much for joining me today. I'm going to have you hang tight while I just kind of wrap things up here, and we'll talk after I take us off live. So that's our show for today. I thank you very much for joining us. Tomorrow, 10 a.m. Pacific time, is my show, Business Lessons from the Military. We're going to be continuing our discussion about applying the rules of military intelligence to our professional lives. We're going to be talking about what is it? Boy, I forgot what the specific topic is. But if you go to our Eventbrite page, again, you'll see the links in the show notes. You'll see what the specific topic is for tomorrow, and then on Wednesday is again at 10 a.m. All our shows now are at 10 o'clock in the morning, so you can visit us at the same time each morning. So my guest is William Elkins IV, and he's going to talk about how he parlayed being an Uber driver into starting and running his own private car service. So that's people making money, 10 o'clock Pacific time on Wednesday. And then, of course, 7 days from today, we'll be back for the next edition of Trusts and Estates Weekly. So thanks again for joining us. Wishing you a wonderful rest of the day and looking forward to seeing you later this week. Signing off as I always do. Marie, you are my bell. Thanks so much, folks.